Good afternoon. My name is Ellis, and I'm joined by my partner, Hugh, Campbell, and we are very excited to share our analysis of the Google tax case. The Google tax case is an interesting case as it deals with the discrepancy between where digital companies do business and where they are primarily taxed. So in this case, there are three key issues and considerations that we looked at when making our recommendations. So the first key issue is that countries have varying tax rates from each other. So in this case, at that time, Ireland's corporate tax rate was only 12.5%, which was lower than other European countries, which is why Google chose to locate their headquarters there. The next key issue is that taxing digital services is a complex problem, as customers can be located in a location such as London. However, the sale can be made from Ireland, meaning that it would be taxed at Ireland's rate and not what the typical London rate would be. And finally, this issue extends well beyond just Google, with 75% of the top 50 digital service providers using a similar strategy. My partner Kaylin is going to go out over the second half of the double Irish-Dutch tax sandwich later on in this video. However, to analyze the first half of it, we can start by looking at how Google is making its sales in Europe. So Google is employing a number of marketing agents across Europe who will go and speak directly with clients and customers in other countries within Europe, and they can explain the Google process to them and walk them through the sales system. However, they do not actually finalize the sale with the customer. The customer has to actually go and make the sale directly with the Google Ireland subsidiary. So this means that instead of being taxed at a high rate, such as if the sale were made in the United Kingdom, it would only be taxed at 12.5% because the sale is made with Ireland. So additionally, Google has allocated all of its intellectual property to this Ireland subsidiary. So this means that this Irish subsidiary can then lease and sell this IP back to the other parts of Google, such as Google US, and then this income is then taxed again at the Irish rate of 12.5%, which would be much lower than if it were the other way around. So this graph was taken directly from the case. It shows the discrepancy between the number of internet users in each European country compared to the revenues that Google has. So while a country like Ireland has the least number of internet users, it has by far the highest amount of revenue at over 20 billion, whereas a country like Germany has by far the most internet users, but barely has a billion in Google revenues. So this graph demonstrates how Google is redirecting all of its European sales to Ireland to take advantage of Ireland's 12.5% tax rate. While Google is employing this complex tax strategy to save on taxes each year, they still claim that they have paid over 23% each year for the past 10 years, which is in line with what other companies are paying. Google feels that they are doing nothing wrong by deploying this strategy, and they are just following the rules in their current state. While what they are doing is legal avoidance and they are not breaking any laws, it does demonstrate the need for change. One tax law change that Google has advocated for in the past is to shift the taxes to be paid to the country where the consumer resides rather than where the supplier is headquartered. Our team has two recommendations for tax law changes that would help prevent similar strategies from being used in the future. We're going to touch on these strategies again in answering question 4. Our first recommendation is to bring the corporate income tax rates closer together across all European countries. This could mean setting a minimum corporate income tax rate for every country, such as 15%. Our second recommendation is to shift the tax to be paid to the country where the buyer resides, especially when dealing with digital services. This would help prevent companies from diverting all of their sales to the corporate headquarters when it's located in a low income tax country, and instead the tax would have to be paid out regardless, as it's being paid to the country where the buyer resides.
The first question that we look to answer is what makes taxation of digital commerce so different and complicated? So unlike traditional brick and mortar businesses, digital commerce includes unique tax challenges due to a lack of physical presence in the foreign country, large intangible asset capital, and complex value streams. It may be also challenging to determine where user locations are in combination with rapidly evolving technologies. These challenges, along with varying jurisdictional tax regulations, make taxation of digital commerce so different and complicated. Next, we looked at how it has been legal for companies like Apple and Google to structure their global operations to position where profits are recorded for tax purposes. Apple and Google are two of the most prominent examples of companies that strategically record their profits for tax purposes. They, among others, exploit several aspects of the international tax system. One of the major exploitations used by these companies is the difference between territorial and worldwide tax systems. In a territorial tax system, income is taxed based on where it is earned, which generally exempts foreign-sourced income of residents. Worldwide systems tax all income of a resident regardless of where it is earned. However, they often offer foreign tax credits to avoid double taxation. For Apple and Google specifically, they would establish subsidiaries in low-tax jurisdictions and strategically attribute these profits generated from sales and activities from their higher tax countries to these subsidiaries. These profits, attributed to the low-tax regions, are not immediately taxed by the parent's home country until the money is brought back local, which the company avoids at all costs. What companies like Apple and Google tend to do is either use this money to pay out dividends to shareholders or reinvest in the company to avoid bringing the money back local. Thus, it is not taxed at the home country's rate. Question 3 states, many tax analysts have always considered the double Irish-Dutch sandwich the result of a series of very special circumstances, and why is that? So essentially, there are three main factors that contribute to the double Irish-Dutch sandwich that make it a series of very special events. The first of these is the unique Irish residency regulations that allows a company to incorporate in Ireland without becoming an official resident. In doing so, this directly opens the door for the double Irish-Dutch sandwich, as these corporations are legally present within the EU framework without being obligated to pay the same rate of tax as a resident corporation. It also offers significant advantages, with dividends being paid to other EU nations, specifically the Netherlands. Second, there is a very favorable Irish-Dutch treaty that allows companies to transfer funds in the form of dividends through the Netherlands without having to pay any sort of withholding tax, which results in significant tax savings. Finally, there is the Dutch participation exemption. This is a rule within the Netherlands corporate tax system that exempts dividends and capital gains received by a Dutch subsidiary, domestic or foreign, from Dutch corporate income tax. The main key to this loophole is that if any of the keys to it are broken, the system does not function. Finally, we will be discussing what is the most likely future direction of digital business taxation. There are a few options that may be considered to fairly determine the direction of digital business taxes. The first and most prominent discussion to date surrounds the idea of a global minimum tax rate for multinational enterprises. In theory, this would deter companies such as Apple and Google from simply establishing subsidiary corporations in low-tax countries where they can direct their profits. With a global minimum tax rate, there will still likely be some variation in tax rates around the world, but there will be more incentives for these companies to pay the appropriate taxes in the countries in which they actually conduct business. Second, there will likely need to be specific tax regulations for digital businesses. Because this is a new global area of commerce, regulations are currently lacking. It is important for these regulatory bodies to adapt to new and ever-evolving forms of commerce, specifically the idea of digital businesses. A digital service tax may force companies to be taxed in the country in which they conduct business, regardless of whether or not they actually have a physical presence in the country. Finally, there's the idea of increased auditing and enforcement for large corporations. With fast evolving technology, specifically in the digital business area, It will require adapted and improved auditing techniques to ensure that all of these major corporations are following the appropriate regulations. Thank you for listening to our thoughts, analysis, and recommendations for the case of the Google tax.